Hi everyone, this is Marvi Valcourt, and I am the marketing manager here at TDG. And I want to welcome everybody to the event today, the economic impact of COVID-19. Just a couple of things that we are going to record this session and have it available later for broadcast. And also, I want to encourage all of you to use your Q&A function feature on the bottom of your webinar panel. And if you have any questions, please feel free to use that Q&A function. And I will now unmute all of my panelists. So hold on one second. Let's see. Okay, so I think all of you can unmute yourselves now if you can. There we go, and then we can start. And I'd like to introduce Matt Pendo from Oaktree Capital to do the introductions and to begin the webinar. Thank you.
Thank you, Maravi, and thanks everyone for joining us this afternoon. Our panelists today are Tony Bernardo, the Dean of Anderson School of Management, Ed Leamer, Professor of Anderson Forecast, and Justin Barton, President, UCLA Investment Company. Why don't I have them each spend a minute just introducing themselves and their background. We start with Tony.
Great, thanks, Matt. Hello, everyone. Before we begin, I'd like to start by saying that as a community, we're deeply outraged over the killings of George Floyd and other African Americans recently, including Breonna Taylor and Ahmaud Arbery. At UCLA, justice, respect for all is fundamental to our character. So I think it's critical for all of us at this time to stand for equality and civil rights for all. I'm Dean at the UCLA Anderson School of Management. I've been on the faculty at UCLA for 25 years and now serving as Dean for the last year. And I'm happy to be part of this panel and being here with you today.
Ed?
Yeah, I would like to echo what Tony just said about the situation that we're in, but I would like to go beyond the criminal justice system and suggest that we need to have a total makeover of society to offset the wrongs that have existed in this country almost since it was founded. I myself am a professor of economics at UCLA and the Anderson School. I've had kind of three careers. One is econometric theory, international economics, and more recently forecasting. I've been working hard trying to figure out what this economic downturn is really like and how history helps us understand it.
Great. Justin?
Thanks, Justin Barton. I'm the President, Chief Investment Officer of UCLA Investment Company. We manage around $2.8 billion of assets for the UCLA Foundation, endowed assets. It's a global multi-asset class portfolio. I spent most of my career in the institutional investment space, a large chunk of that investing in emerging and frontier markets, but have started my career in the university endowment space and very grateful and proud to be part of an incredible institution in UCLA and really an incredible public institution at UCLA.
Thanks to all of our panelists for joining. I think I'm going to start off with, since the topic of today's webinar is the true economic impact of COVID-19, maybe start with Justin, but turn it to others. You know, as we look at this recession versus other recessions that have come before us, think about the recovery here versus other recoveries, whether this is, you know, V-shaped or U-shaped, L-shaped, W-shaped, different descriptions for the type of potential recovery. Do you want to just talk about how you are thinking about, you know, this recession and the recovery, Justin?
Yeah, sure. I'll get it started, and you know, I'll start, Matt, with just a comment that, you know, one of your colleagues is sort of, I think, required reading on a lot of kind of high level thinking around this, and you know, Howard Marks put out I think a really good piece in the last week on just uncertainty, and you know, one of the hallmarks for us when we try and assess what's kind of happening is a reminder that, you know, markets and the economy really are complex adaptive systems. And so, you know, the question of V-shaped, U-shaped, L-shaped, W-shaped, a lot of that's going to come. There's just a lot of uncertainty, and a lot of it depends on what our actions are, and that's incredibly tough. And so, these types of environments, I think, just highlight how hard it is to predict kind of what's going to happen. Where does it leave us? I think you play a lot of different iterations, multiple iterations on what could happen, what is likely to happen, and kind of using different experiences, because this is unlike any other economic circumstance we've seen, certainly unlike anything, anyone other than maybe folks who were alive. And I don't know that there's anyone who was investing who's still alive in the Great Depression. We see a lot of kind of similar dynamics in the marketplace, as well as, kind of unemployment there. To me, there is a disconnect in financial markets and the economy, I think in part a reaction of having this irresistible force being economic conditions and the unmovable object of the Federal Reserve and their actions. And that really has kind of created I think a great deal of confusion. And we see some accelerating trends in structural issues that were already in place prior to the catalyst of this pandemic, and sorting through the economic implications is going to be, I don't think it's a couple of months. I think it's probably a couple of years. And I'll pause there and let some others chime in. We can continue to kind of discuss that topic or move on.
Sure. Ed, you want to comment?
Yeah, Justin brought up this word uncertainty. It reminded me of Frank Knight's 1921 book on risk and uncertainty and entrepreneurial behavior, in which he distinguishes situations in which there are known probabilities, that's risk, and situations in which there are unknown probabilities. Most of finance is built around risk and not uncertainty. And that means that you can rely on historical behavior to predict the future. For example, you can look at somebody's batting average and get a good sense about whether they're going to get a hit at the next time at bat. But I agree with Justin that we're in a totally different kind of phenomenon. This isn't a recession, this is a shutdown. And it's very hard to find in historical record anything that gives us much in the way of guide about what comes next. I have opinions about that, but they are opinions not based on risk, but based on uncertainty.
Tony, anything to add?
Yeah, I think both Justin and Ed have spoken about kind of the overall, begun to speak about the overall economy. But one of the things I worry about and been thinking about is just the disparate impact of COVID-19. Disparate impact in terms of health. We're seeing very, very big differences across racial groups and income groups in health outcomes. I think the effect on educational outcomes are very disparate. Families from low incomes don't have access to the technology, the extra resources you need to succeed in this kind of environment. I fear that some of the trends that we saw, growing inequality get exacerbated by this. And then I think there's, another issue, which I think, is something we're going to have to grapple with, is the intergenerational differences. We have young people who face a very challenging job market. We have policies that are raising taxes that are going to have to be paid at some later date, and so the young in particular, while they may not face the same health risks, are bearing, I think, the financial consequences disproportionately. So beyond the overall level of the economy and overall performance of the economy, I think we have to really keep a close eye on the disparate impact.
It's helpful. Tony, maybe just as a follow-up, and you talk about the impact, how do you think this is going to impact, higher education, how education is delivered, those types of things that UCLA is thinking about?
Well, this was a great experiment in the following sense. All of the activity, all the innovation, all the work that's been going on towards this remote learning modality, would have taken years and years and years. We had a lot of reluctant people, reluctant faculty who didn't want to do the work, reluctant students who thought that this kind of teaching platform was frankly, completely second class. And I think what we're seeing is tremendous innovation in teaching methods using this kind of technology. And it's not just innovation at UCLA. You have to keep in mind every institution of higher learning, almost every institution K through 12 is using these technologies. We're using these technologies in workplace. So there's going to be tremendous innovation because we're all doing it. We're all sharing best practices. And you have to think that that's going to fundamentally have an effect on how we deliver education going forward. In particular, it should be helping us think about how we provide education in a more cost-effective way. Obviously, we've seen tremendous inflation in the cost of higher education in particular, inflation plus 3% for 20 years. That's unsustainable, and this technology may help us solve that problem, provide broader access. So I see it. I think it would be foolish to think that all of this innovation, all of this work is just going to get filed away until the next pandemic. I think this is going to change the way we work and learn.
And if I could just add, I think not only can it, I think it must, just because I think we're going to need retraining and reskill development. And so the more education that we can really kind of provide our society, the better off we're going to be, because I think a lot of the service roles that we've seen kind of people in, and even some manufacturing roles that we've seen people in, are not necessarily coming back. And so, the need for that education is so much more important.
I'd like to contribute to that same comment. The inequality in education go hand in hand to some extent. I think we built the middle class in the factories of America. We had about 35% of our workforce in manufacturing in the 60s. Those were good jobs for the kids who had high school degrees. And that fraction has gone down from something like 35% all the way down to 7 or 8%, which means that the high school degree as an asset has basically been destroyed as we're moving from an industrial to a post-industrial world. And we need to create a workforce that is suited to the reality of the 21st century, which is not manufacturing. It requires more education, but I worry that it also requires a talent level that many people simply don't have. And we're going to need, as a culture, to find some way to recognize the contributions of people who may not have the education, may not have the talent, but still doing essential things like working in a grocery store. Those are people we should admire, just like we admire professors. That's the kind of cultural change that needs to be put in place in order to address the inequality that simply isn't going to go away. I think it's going to get worse and worse.
And then maybe just picking up on that, we talked about kind of the future of education, with technology and the impact of COVID-19. How about, Ed, maybe kind of the future of the workplace? You see kind of picking up jobs, employment.
Yeah, well, I make the point that it used to be that memorization is all you had to do in college. Our classrooms were basically big Xerox machines where the faculty or teachers would lecture and the students would write it down, and then you test them to see how good the Xerox machine was working by how well they had written it down and had memorized it. But the reality of this world that we're moving into is memorization is done much better by computers. And if that's the only skill you have, you're not going to do well in that world. So we need to emphasize a whole lot more creative problem solving, analytical thinking. And you learn that from experiences, not from lectures and exams. And we still have universities that are too much oriented to the 20th century and not the 21st.
Tony, anything to add on how at Anderson you're thinking about future workplace and things brought to light?
There's no doubt that we had to make a transition in the last 3 months towards a fully remote learning and work environment, and for many of our staff, this environment is one where they can be productive, and there's other benefits that come with that. We have many staff who have to commute long distances to get to UCLA both ways. having perhaps a day or two a week where they can spend more time with their families and do other things that they value would be beneficial while they continue to be productive. I do think, though, there are certain activities that lend themselves to in-person sort of serendipitous contact. I think, I've spoken to people in finance, for example, where you want to run ideas by somebody in real time. There's a trade, and you want to make, you're trying to get information and bounce it off somebody, and that doesn't work in a Zoom meeting. Or if you're an academic and you want to, so you run into somebody in the hall and you say, I've been thinking about this, and what do you think about this idea? Those kinds of serendipitous conversations, that I don't think that gets well done in this format. So, we have to find the right mix. The right mix depends on the nature of the work. But I think it is a part of our future. I also think it, as a business school dean, it's got to be part of our curriculum. Our leaders and managers are going to have to understand how to manage in this remote work environment. And that raises all kinds of questions: how you motivate workers, how you negotiate, how you form teams, on and on and on. How you're persuasive, and all of these things are huge challenges for us in terms of curriculum. So obviously this has been a very, very challenging time, but on the other hand, it's an exciting time when you think about the new possibilities that might become available.
Right. Justin?
So a couple things I'd like to just kind of add on to, and maybe slightly also at the end, I'll slightly tilt the conversation, I think, brought to broader work issues. But, I think, look, this is an incredible technology that we're on right now, right? And it's wonderful, but it's also not the same as interacting with people directly. And I think those are a lot of what make us who we are as a society. And that's in some ways what makes this particular kind of economic circumstance feel more painful, is it creates separation, right? That the parts of the economy that are most impacted are what make us a society, right? It's going out to restaurants, it's social gatherings, it's being around people. I think what's interesting is, like, everyone on this panel, it's easy for us to do this and say, well, this works. It's not a long-term solution, and it's really, all of us have careers that we've been at for 20, 30 plus years. If you think about, younger graduates, people who are starting their professional careers, and the connections that you make with your colleagues that, really iterate over time. And it starts with college, right? The people that you get to know, that you share space and time with. That, I think, is what really concerns me longer term for the future of work. Because, as Tony said, those serendipitous parts of life are really tough to manage digitally, and I think are really where you get a lot of creation. But just to kind of maybe to slightly tilt in terms of where does this lead us? You go back to, and this is where I'm talking about the acceleration or catalyzing certain things of what make kind of structurally higher unemployment. If you do a thought experiment and said, okay, instead of having existing infrastructure of retail, snap your fingers and you just start retail today. What does it look like? I think you got probably at least 50+% as e-commerce. So what do you do with all of those people who are working in those jobs? We've been talking, and people, I think, criticize the West and California for being, too forward-thinking, too venture-oriented, but I think it's a great thing. We've been talking about, autonomous vehicles, autonomous trucking. Trucking is one of the largest employers in this country. What do we do so those are, I think, the bigger kind of employment-related, and you got, on one side, you've got white-collar work or office work, and on the other side, you have, hey, what is the future of work? When you've got the biggest pieces of employment in this country getting ripped out.
So there is a question from the audience in regards to that hybrid working, whether it's online, like you said, Justin, or both, brick and mortar online. what about the part of the folks that, you know, can't afford a computer or laptop or Wi-Fi? You know, we're seeing that now in the education system, the disparity between that. You know, do you think that there'll be solutions moving forward, or do you think that disparity will still continue?
Tony, you want to take that?
Yeah, I mean, not only just, I mean, I think, you know, coming out of this crisis, not just access to technology, you know, I don't know if many of you know this, but, you know, we had a big, led by the Dean of Undergraduate Education, we had a big fundraising around getting technology for our undergraduate students who couldn't otherwise proceed with their studies. And there was a tremendous need for this technology just in our, you know, in our own community. And so that's very real. Some people don't have quiet workspaces in their homes to conduct work. Another issue I think that's going to come about, you know, as we emerge from this crisis, access to public transit. Not everybody has access to their own vehicles, and they have to get to work using public transit, and that could be severely restricted. And so I do think that creates another set of you know, of inequalities. Obviously, workplaces like Anderson, one of the things we've been doing is, to whatever extent possible, providing technology for our staff who need it at their homes. But not all employers will be able to do that. That's going to be something we're going to have to be very mindful of.
So these are symptoms of the amount of inequality that we already have, and it's only going to get worse. We've got to have leadership that wraps their arms around this and prevents this from happening by making sure that every kid in America has decent technology to learn and to communicate with others. I do want to say something else about what Justin was saying a minute ago. The Schumpeter and Marx used the word creative destruction. Creative is your new ideas, and destruction is a reference to the things that your new ideas destroy. And our capitalist system is built on the creative aspect and ignores the destruction. IBM, when it was a monopolist, would introduce a new system of computers, not right away, but only after the existing system had led to adequate profits for IBM. So it controlled the rate of innovation. Now that innovation in the tech sector is completely competitive with lots of different entrepreneurs creating that, it's a setting that completely ignores the destruction that occurs. And to me, one of the greatest destructions that we've had in the last 50 years has been destruction of the high school degree. So it used to be that was an asset that would get you a decent middle-class American life. And it doesn't do that anymore. And if that's what you had, that's not worthwhile anymore. I worry that artificial intelligence, machine learning is going to diminish the value of a college degree, at least for those who have to compete against computers. And the problem is that we need to, as a society, worry about the destruction, not just the creation. Jeff Bezos, he earned all that money mostly by destroying the retail sector. The net value that Amazon created is substantial, but most of the wealth that accrues to Amazon is because the retail sector had been destroyed. So had the retail been in control of the introduction of this new technology for internet-based purchasing, then you wouldn't have had the incredible collapse of the retail sector that we have now.
I think just touching on the subject of kind of Wi-Fi accessibility, you know, without being a public policy expert, you know, one thing that would strike me as a potential solution here for a host of reasons would be investment from the government. So we talk a lot about investing in infrastructure. You have things like the interstate highway system, which was a huge investment in essentially now, I mean, there was, I guess, a military advantage to it as well, but a huge investment in a economy that had a very different makeup, 70 years ago. Maybe you have, government investment in the infrastructure that provides lower cost connectivity and technology, but that's out of my scope. So that's
Andrew Yang was talking about giving $1,000 to every American family, I guess. You ought to give them a MacBook too. A new one every year.
certainly will be good for Apple.
Yeah.
How about just kind of picking up some of the themes? How, maybe turn it to Tony. How do you think about globalization now going forward with the impact of COVID-19?
Yeah, to me, the slowdown in globalization, at least from the perspective of the profitability, the cash flows that are going to be generated by the large, U.S.-based companies. So if you think of the market here more than, say, the broader economy, obviously the market, when we think about the market, we're talking about large firms. A lot of those firms have more of an international presence. They have global supply chains and so on. So I'm speaking about a narrow part of the economy, the real economy that's reflected, say, in the stock market. But to me, that I think there's a couple of forces here. One is the worrisome increase in nationalism, and then the second force is along the lines that Ed has already pointed out, the erosion of the middle class, the manufacturing jobs in the U.S. in particular, which was part of the reason we have a lot of sort of nationalist sentiment. But now there's a lot of discussion about having strategic supply chains that are more diverse, perhaps more domestically based, to protect against these kinds of crises. And all of those things, I believe, are headwinds for large firm profitability. Although they may have economic benefits for many others, but for, I think, the largest firms, that to me is where I see the potentially biggest headwinds in terms of valuations and long-run prospects.
Ed, anything to add on globalization?
Globalization is like technology. It allows you to produce T-shirts with great efficiency, where Boeing produces one aircraft and we trade it to Asia for 7 million T-shirts. But what that does is that new technology has a destructive aspect to it, similar to what I was saying before. And the result was we lost a lot of manufacturing jobs. But I think most of the decline in manufacturing had to do with technology, not with globalization. But I want to add that the Trump administration is not concerned with balanced trade and importing labor-intensive products and exporting capital-intensive products. It's concerned about the trade imbalance, something like a $600 billion trade imbalance, and would like to shrink that in some way. I think that's a mistaken concern, that it's a kind of what economists used to call, or still do, mercantilist thinking, that a big trade surplus was a symptom of strength of the economy. And the Asian countries have all run these surpluses, and the U.S. has run a deficit for a long time. The deficit is a symptom of an economy that has not enough savings to fund its own investment opportunities. So we have to rely on foreigners to fund those investment opportunities. And that means foreigners buy U.S. dollars to acquire assets. That drives up the value of the dollar and makes it harder for us to export. So a lot of the problems in exporting have been caused by, well, the federal budget is a contributor to our weak national savings. So I think globalization is a complex issue. Most economists were 100% in favor of it. And all of a sudden, within the last 4 or 5 years, they changed their mind because of the damage that's been done to the political system. But I don't think we can walk away from it. I think there's a lot of benefits from specialization according to comparative advantage.
Yeah, I think a lot of times so geopolitics is a real concern, I think, and trying to handicap that is tough. And I think a lot of us kind of come to it as globalization, but it often strikes me as really just a question of Chinese-U.S. relations. And, the disruption of supply chains and the risk that we see for businesses, I think exists really all over. And when we try and assess risks, that's where barring outright kind of, I guess, censorship of investment or whatever you want to call it, the risks seem higher in the U.S. because of what's priced into companies. So, I mean, we mentioned Apple earlier. Apple has, to me, similar, let's say, China risk to a Chinese equity company from a U.S. investor's perspective, but you're paying a lot more for that risk with something like Apple. And so that becomes a real question. Well, what happens if these businesses, let's say in the U.S. that have international linkages, have to change the way their manufacturing process works or the way their economic process works? And I think that is a huge risk when you have securities that are potentially priced for perfection, or expectations of much higher margins because of where the factors of production are based. And I don't, I think it's pretty interesting that it seems like one of the few bipartisan views today is mistrust or distrust of the essentially second largest economy in the world. So when you look at Democrat and Republican views on China, there seem to be both negative.
Well, I think that goes back to blame the foreigner again, too. So we have troubles at home. We're always going to look to the foreigner as a source of it, rather than recognizing that it's our own public health system that has not done well this time. I will also add that it's very hard for a capitalist system to prepare for things that could occur in the future, because each business is carrying that extra cost for that preparation, and it's just wearing them out to think they're getting no return. The business leaders are thinking this is a crazy thing to do, to have all the stockpile to deal with potential shortages in the future. So I think that probably has to be done by the governments, but I think that the voters don't like to do that either. So I think it's pretty difficult collectively. We've seen it with regard to this pandemic. We're totally unprepared for it because not because we knew. Not because we didn't know it was coming, but because we didn't know when it was coming.
And how about, maybe we'll talk a little bit about, I'll turn it over to Tony, but we've talked a lot about kind of large companies like Apple, but how about kind of smaller companies, the venture capital community? What are you seeing in Anderson in terms of interest and desire to continue to be entrepreneurial and start new endeavors at a time like this?
Yeah, I mean, we are at Anderson. We have seen over many years, and there's lots of sort of data to support this. We're attracting students who more and more are interested in starting new ventures. They're more and more interested in careers in technology. They're more and more interested in staying in Southern California, which is great from the perspective of benefiting the local economy. So we've really increased our efforts in terms of, promoting those parts of our program, including, investments in accelerator space for some early stage companies that our students and faculty across campus have access to. So we're still seeing that. Spirit. There's, I think, again, disparate access to finance right now, depending on the nature of the business that you're developing, and also the nature of the backers. I think this is something Justin knows more about than I do. But this is still, if you look at sort of demand among our students, this is still growing in popularity. So I think this is part now of our brand at Anderson, and we're seeing more and more of our students who want to pursue those careers. But in terms of conditions on the ground, Justin probably knows more about this than I do.
I mean, I guess one thing I'd say is, it's interesting. A lot of the great businesses, great venture capital companies are founded in periods like this, in in more trying economic circumstances. Why that is, I don't know. I mean, maybe hazarding a few guesses, it might be that, well, only really great ideas are going to get funded at a time when capital is scarce. I think today is, yeah, it is. It's going to be really hard for those without a demonstrated track record, whether the track record is merited or not. But without that proven capability or experience, it's going to be very hard on a fundraising standpoint. But that also means if you've got a great idea, people will listen, and I think people are looking for great ideas rather than Me Too ideas. At which you see a lot of venture kind of firms looking at the something that, oh well, this works, so let's fund something that looks exactly like it. The better or higher reputation firms, a number of them is certainly in the venture space, are in the market today and are heavily oversubscribed, and those typically are capacity constrained strategies. So fortunately or unfortunately, I mean, no judgment on it, but it strikes me as similar to the rest of this market dynamic, is that you've got the haves and the have-nots, and those that have the cachet and the power kind of continue to deepen their moats, and those without it are left in a much more difficult position because people are really pulling back. And as you dig into investment companies, I think most venture firms have told their companies to prepare, and I think it makes sense to prepare for a challenging situation, which means cut your burn rates, be very focused on what your costs are going to be, and try and generate longer runway, because it's going to take a longer, it's just going to be a more discerning market out there.
Interesting. One of the things Tony just mentioned was, students want to stay in California. Maybe, Ed, as you think about, one of the things we talked about earlier was the kind of the state and local government finances, the municipal market. What's your sense of the impact of COVID-19 on the municipal market, state and local finances?
Well, are you talking about on the economy?
In the economy.
Yeah, that's going to be a drag on almost every municipal in California and the state overall. There's just not going to have the revenue. They're going to end up with adequate revenue maybe to do their debt service and pay retirement, but hardly anything to take care of the streets, and education is going to get neglected. I think it's going to be a big problem going forward unless the federal government steps in, which it's talking about, steps in and really helps out these municipalities, basically borrowing at near zero interest rates to offset the budget problems that's happening at the state and local level.
To add to that, we also have, in this environment, present value of liabilities. If you think about unfunded pension liabilities versus assets, that's just widening tremendously in this environment. You've got huge increase in the present value of liabilities and decrease in asset valuations. So you've got and also at the state level, heavily reliant on capital gains and income taxes. Those are a lot of challenges for local and state.
So on that point, we've had these incredibly low interest rates around the world, and even the U.S. Treasury has dipped into negative territory for a short period of time. But low interest rates make for high price earnings ratios for hard assets like homes. So we've seen a big elevation of value of homes, in part not because the economy is growing, but because interest rates are so low. Well, what that does is it freezes out a group of population. The people are renters or their future potential buyers are going to have to pay enormous amounts. So we're creating, through low interest rates, a more amplified inequality in this country. Those who own their homes are benefiting immensely from these lower interest rates, and those who don't, either current potential buyers and future buyers, are going to be in a much more difficult state.
I think what you're saying is a low cost of capital helps those who have capital.
Yeah.
And that gets back to my intergenerational.
That's the point.
The young don't have any of it. That's the problem.
Yeah. They have the debt. They're
They have the
going to have
debt,
to.
but exactly. That's right.
So the questions that have come up is, it seems like it's a pretty dire outlook. But if it were in the hands of you to rebuild the economy, where would your focus be?
Well, the focus should be on public health. If we had a treatment that really worked for this coronavirus, and if we had a vaccine that made us all comfortable again to go to a restaurant and go fly a plane, then we could get a very sharp V return to normal in this economy. But the longer that it lasts, the more the permanent damage that's done, and a year is a long time, really, in terms of how the economy is going to respond after the virus is cured. And it seems likely the virus is going to be with us on a continuing basis, in which case there's not much the federal government can do. It's not, you can't stimulate the economy to get us to go back to restaurants and get on an airplane again. Number one is to cure the public health problem.
Justin?
Yeah, so one, what I want to say is that humans are remarkably resilient. And I take a lot of positive energy from the number of people that are working on various solutions. But I'm not involved in biology, epidemiology, anything like that. But the number of people around the world working on vaccines, working on treatments, working on ways forward, I think we'll find a solution for for this disease. But just on the resiliency part, and going somewhere with this, no spoilers here either. I started watching the TV show Deadwood during this pandemic because I'd heard it was a great show. I never watched it a long time ago. And I got to a point where there was a smallpox outbreak. And, I was like, oh, it's, smallpox. I always heard about that, but it's, it was eradicated. And then I started really digging into this. This is a disease that in the 20th century, and it was eradicated in 1980, is estimated to have killed 300 million people in the 20th century alone, and 500 million people in the last 100 years of its existence. And we were able to kind of move forward with something as horrible as that. I think we will find a way forward from this disease. We will, I feel very good about that. But the economic impact, it takes a while for it. The reason I think people are saying that it's pretty dire out there is that it is. We have, well over 1 in 5 working Americans has lost a job in the last 2 months. We've had an incredibly strong and I think positive response from government to try and stem some of the pain. And, you've seen this additional support. That one of the concerns is what happens come July if people cannot go back to work and the $600 a month rolls off. Now you start seeing some decline. But right now people have the money in their pockets to be able to make rent, to make these various payments. And as long as that, we need to find a way to keep that going so that we can slowly reopen the economy, and that will help get things moving.
So the reference to smallpox or maybe the pandemic of 1918, I think is your recommendation that we should not have closed the economy down, and we should just put up with the COVID cases that occurred, and then we wouldn't have. Then let me just finish. So the problem with shutting it down is it creates a kind of psychological collective opinion about the danger that this COVID virus represents. And as you know, after 9/11, it took 3 years before the airline got back to where they were. And that seems they hold on to that fear for a long period of time. I think I will too. I'm in that age group that has to worry about this situation. And I don't want to go to a restaurant that has all those it has half the tables that normally occur. And I'm thinking this guy who's delivering my meal just coughed, and I don't want to open that. So I'm just worrying that I'm speaking for myself. You probably think differently, but for myself, it's going to be a while before I jump on a plane again and even go to a restaurant again.
Tony, anything to add?
Yeah, I don't have a lot of insight into this. I mean, in terms of the behavioral response, I mean, I think some of the predictions that we're going to have vaccines in a short period of time are very unrealistic. And so a lot depends when people talk about this U or V or whatever the form of recovery is, how these behaviors change. And I would say, to me, one of the issues, and it gets back to something I said earlier, is we have to think about ways that we can reintroduce younger people into kind of the workforce or into the kind of things that young people want to be doing at this stage of their life, and protecting those who are at higher risk, and do that in some sort of measured way. I'm really concerned about the long run consequences of young people not being in school situations, not being in early career situations. We know these have long run impacts. And so if we can't all sort of behaviorally come to where we were before, I think we have to really think about ways that we reintroduce young to education, to work and career experiences that are going to have long run impacts for them. And somehow we have to think about protecting the highest risk individuals while we try to preserve opportunities for them. But I think fundamentally, how we behave, how we collectively behave in the absence of a treatment or a vaccine is really fundamental to how we come out of this. If you think about the industries that are going to be tremendously impacted based on our behavioral response, all of tourism, hospitality. You think about all the events that we do now in this way that we won't be doing, and all the sporting events, entertainment events, even all the things around the gig economy that people were sort of hopeful about growth. People aren't going to want to share Uber rides, and they're not going to want to share their homes and all of these other things. So many emergent industries, so many industries are dependent on our behavioral response. Mm-hmm. And I don't have any deep insight into how we will all do this, but to the extent that we can, I really am concerned about preserving the opportunities of the young, particularly around early career and education.
Right. I know we talked a little bit about interest rates, negative interest rates. Maybe a related question is just deficits. How are just the federal response and all the spending and stimulus. How do you think that's going to translate into the economy, whether it's through inflation or any other impacts?
Well,
Justin, go ahead, Ed.
The usual reference is to debt service going forward. It's going to take a larger and larger bite out of revenues to do the debt service, but that's been pretty much offset by the lower interest rates. So to the extent that Uncle Sam doesn't start looking like Uncle Demetrius to the global bond market, worrying about whether he's going to really pay it back, then we're in pretty good shape. But I still think that if we get the inflation which you're hinting at, the global bond market's going to rethink its commitment to the US dollar and to US treasuries, in which case we could have a kind of Argentina or Mexico or one of these developing countries crises in which the bond buyers fled the US dollar all of a sudden.
Justin?
Yeah, I think, first of all, you probably have to see some kind of increase in revenues, right? So, and that essentially is taxes. I don't know what the tax policy is, but that's probably a high likelihood given obligations that we have outside of even the current fiscal spending that's going to happen. And it's less likely, I think, that you grow out of it, right? Because that's one way to pay down your debt is through higher growth. But it's pretty hard to grow an economy that, who knows where we end up this year, but let's call it last year was what, $20 trillion. So to grow that at a nominal 5% rate is pretty tough to find that amount of dollar growth. So you probably have inflationary pressure. I think we've got some deflationary impacts out there. I mean, that's why you have kind of automation and other things taking and destroying certain jobs and job areas. On the inflation side, or let's say the loss of the dollar as a reserve currency, I think we've got to find then what has the absorptive capacity to take that. So what are you going to put that into instead of U.S. Treasuries? And I still haven't found a good answer for what's the substitute. And so I just finding how we're going to lose faith in the dollar when the dollar dominates in such a great kind of quantum is hard to. I don't have an answer there.
Inflation, though, is what I was brought up. If we had this burst of inflation that people were worrying about, and the bond market would have a hard time dealing with this. Let me say something about what I think should have been the right public policy in response to this economic downturn or shutdown. We should recognize that people whose jobs were taken away, they're not unemployed, they're working for us, helping us control the spread of this virus. They're staying at home, working for us. So we should make them all whole. We should make sure that they get paid exactly what they were paying, what they were earning at the restaurants, at the hotels. That should be paid for by a tax on the people who have their income now, and probably a progressive tax as a way of saying this is where the money should come from, not some unforeseen future taxpayer. But let's take the people who are not being directly hurt by this coronavirus and let them make a contribution to the people who are working for us. They're not unemployed, they're working for us.
Tony, anything to add on?
Yeah, I mean, I would say, slightly, related, not fully related, but I mean, one thing that's going to be very interesting is the best use of many assets has changed, I think, for some meaningful period of time. I mean, you're looking at firms that have been, looking at firms in the retail industry that are entering bankruptcy en masse. People are talking about commercial real estate. How much physical space do companies need if they're going to have some of their workforce in a remote environment? There's a lot of assets have, I think, future uses currently that are not as high valued as they might be in some other use. And the process by which that happens is complex and time consuming. And having all of this happen at the same time, not just in one isolated industry, for example, which is typically how we would deal with this, but having it at this scale across so many industries at the same time, that kind of reorganization and redeployment of capital, which is really critical for growth in the intermediate and long run, I'm really not sure we have the institutions. I'm not really sure we have things in place to facilitate that redeployment of capital, and that I think is going to be, if that's the case, that's going to be another headwind.
Any other questions?
Yeah, one of the questions, kind of going back a few minutes to what we were talking about in the workforce. There's a big workforce, probably a lot of the people in the age group that have tuned in today in the 40 plus, let's say 40 to 65 retirement age that are underemployed. So in the economy, and they've probably lost, a lot of people probably lost their jobs. Back to what Tony was saying, they understand that there has to be investment in the young people so they can, grow into this new economy. But what about the people that are already here? How do you see this age span being a force?
So this is related to what I was saying before about the manufacturing jobs in these recessions. The last 3 recessions haven't had recalls; they have been permanent layoffs. So we have all these people who need to be retrained. And they have to have changing aspirations, changing knowledge bases. And instead of having fiscal policy, we should have focused on them. Now, Tony has focused on the young, but there's definitely a group like where the question refers to the 40 to 50-year-olds who over the last several decades have been hammered if they were in their manufacturing sector.
40 and 50 still young. But one thing I would say about that, these new technologies that we talked about with for learning, for the future of education, more and more we know this, that people are changing jobs more frequently, changing careers, and that there's a greater demand to sort of reskill and keep up to date. And I can tell you that just in the last few months, as we've moved to this remote modality, the number of courses, one of the things we've done is we've made events, courses, auditing available to some of our alumni, and the uptake on it is extraordinary. So as this tool that we're using as a way of providing access, not just for young people going through school right now, but for people who want to be retrained, I think this kind of technology is just the best way to provide access at low cost, and just seeing how our alums are taking us up on these on the content that we're providing just demonstrates that there was this huge latent demand that we weren't satisfying.
Reba, anything else? Any other questions? Okay, right now we have a couple of minutes left.
Yeah, we have a few minutes left, and there are a few questions. So going back to the bondholders, I think Ed said that, people would flee the bonds here in the U.S., but one of the questions was, where would they go? Where would the investments go if it wasn't in the U.S.?
That's Justin has that answer, I think.
I mean, kind of that's what I was talking about. I don't think that there is, the size of that market relative to all of the other markets. It's that the absorption capacity is not really there.
So here's my advice, that the Chinese should sell their treasury bonds and buy the Anderson School or other hard assets whose future is very bright.
And maybe on that note, we're gonna maybe I'll turn it to each of the panelists. Maybe just bringing it home to UCLA. Just talk about. I know we've talked about a lot of dire stuff here, but just kind of ending on a positive note with UCLA and the resources and the focus and the opportunity. Maybe you'd spend just a second on UCLA for a second.
Well, I'll just say a few things about our own, community, not just at Anderson, but at UCLA. But I think, I actually think it's been an experience the last few months that we all should be very proud of. I think, what I saw in the last few months is faculty, staff, students rally and partner to try to overcome and really make an excellent work environment out of extraordinarily challenging circumstances. And it really showed the strength of the community. And we also saw across the campus tremendous outreach to the most vulnerable among us. As we talk about a lot, UCLA is a great public institution, arguably the top public institution of higher learning in the country. And to see us rally around the explicit service mission of the school, of the campus and the university in the last few months has really been incredibly heartening. So, a lot of times in these challenging periods, you can retreat or you can rise to the challenge and find opportunity. And overwhelmingly, that's what our community did. And I think that's going to position us to be great going forward. And I think it's going to make our community stronger. So despite all of what we've seen in the last few months, I think it's been a very, very positive period for strengthening our community.
Justin, anything to add?
Yeah. So I'll echo Tony's comments of it's been just incredibly powerful to see the response of the university's administration, students, to what is an incredibly trying time. I'll add also, we're sort of, as an institution, kind of on the front lines, both from the impact from a higher education, but also from a medical system. We're a very large and important medical system in Southern California, and we have, we've certainly seen from even a personal standpoint, just the incredible hard work of our doctors, nurses, and other employees in our health system who are, risking their lives for the rest of our society. And I think that's just an incredible testament to who they are and who we as UCLA are as a society. And I think they deserve our thanks. To end on an even, I think, higher note is, look, UCLA is one of the premier creators of intellectual property in the country. We have unbelievable innovation in science, technology, biotech. There are some really just unbelievable things that are coming out, have come out of, and will be coming out of this campus. And I think it is I do believe that we'll kind of get through this, and we'll have some really amazing things that have come out of UCLA in the next decades or decades to come.
Great. Ed, final
Yeah,
words?
well, speaking as an educator, I've been in this business for decades, and each year I notice the mistakes I'm making, and I try to do better. And year after year, I work very hard at it, just like Tony was saying. And the best reward is when some student that I had a decade ago drops by my office and says hello and tells me that I had an impact on their lives. And there's nothing better than that for an educator.
Thank you. Well, I'd like to thank all of our panelists for joining, and our audience for joining. And I think with that, Maria, I think we should end the webcast.
Yeah, thank you everyone, and thank you to our panelists and all the people who attended. This will be up on our YouTube channel and on our website. And have a great day, and please stay safe. Thank you.
Thank you.
Bye now. Thank you.
Bye-bye.